Sometimes we need a reminder of what investing is all about today on Industry Focus. Greetings, fools. It's Tyler Crow here. I'm actually by myself in the studio today. I guess a couple of people got freaked out by the DC storm. For anybody that is north of DC, New York, Boston area, you're probably being like, yeah, this is pathetic, but hey, it's DC. It's what happens. So, as we've seen over the past couple of weeks, oil prices have been losing their minds. Commodity markets are in turmoil. Everybody's talking about China. We have the Davos Summit, and I'm sure that we could talk about a whole bunch of things like that on this podcast. But today we decided to do it a little bit different, just kind of shake things up, because we wanted to do a reminder of what investing is all about. We talk about stocks on prices, things that can impact them over the long term. But when you're investing as a long-term investor, you're not just buying a stock, you're buying a company, and you're buying the people behind that company. And so you need to get to understand the people who work at this company and how they operate, and looking at that can be a much more effective way in picking the great stocks that are going to generate returns for you over the long term. So in that sort of vein, we wanted to give you a little bit of a different opportunity this time, where we're going to give a pre-recorded interview that my colleague Sean O'Reilly did back in November with the CEO of Distribution Now Incorporated, Robert Workman. It goes through the various questions about the strategy at Distribution Now, its spinoff from National Oilwell Varco a little over last year, and just some general questions on being a CEO and what it's like to be a leader in the energy sector. So here it is in its entirety, and we'll hope you enjoy.
You guys have positioned yourselves as a very unique player in a niche market. What can you tell us about what Now Inc. does with the oil industry, how you're positioned, and how you see the marketplace currently?
So our customer set's pretty wide. It's a huge variety. So we service drilling contractors, manufacturers like Cameron and the others that make products for the oil industry, the service companies like Halliburton and Schlumberger. We also, our biggest customer sets are operator customers that are the ones that are doing all the exploration, midstream providers like a Kinder or Energy Transfer, and then downstream facilities like chemical plants and refineries. So we have a really wide customer set within the energy space. And then we provide a broad array of products and services to that entire customer
30,000,
base.
right?
Yeah. Oh yeah, it's actually more than that, but yes, we don't
growing every day.
Growing every day, and then we're located in almost every energy producing country. So we're in 23 or 4 something countries outside of the U.S. and Canada. So we've expanded greatly since I took over in 2001. And we're going to continue that going forward.
So a little over a year and a half ago, you guys were spun off from National Oilwell Varco. Just real quick for our listeners, what can you tell us about the advantages and disadvantages of being separate from the former parent company?
The advantages are pretty clear in that when you're a group at NOV, you can imagine when Pete was CEO of NOV, he had several divisions, and obviously the manufacturing groups generate pretty good EBITDA margins compared to a distribution company, whether it's us or Granger or Home Depot, right?
Yeah.
And so as we generated cash, he had to put that cash wherever it would best benefit NOV shareholders, which is pretty easy to put it in RIG or somewhere else where you're getting the big returns. So, we weren't able to reinvest in our business to the same degree that our competitors were that were standalone distribution firms. So the big advantage to us is now we have kind of control our own destiny. We're able to make decisions with our balance sheet and our cash generation that benefit solely DNOW. The only disadvantage to being away from National Oilwell Varco is that, most of us, started with the company either as oil well supply or national supply. And so there's a little bit, feel like the parents kicked you out of the house theory, except for the fact that, we brought Pete Miller with us. He's with us here. And we brought Dan Molinaro, who's been the treasurer for NOV for the last 2 decades, been there 45 years. He's now the CFO. And then Raymond Chang, who was the the assistant general counsel and corporate secretary at NOV, is now our general counsel. So we took our entire core management team that's been running the business forever, plus some. So there's really no disadvantages in not being part of NOV, but they were an amazing parent for sure.
And you guys are definitely not small by any stretch of the imagination. So given the shift that's been occurring for the last year and a half, has the strategic vision changed with Now Inc. at all?
No, like I mentioned earlier, the entire core team that's run distribution since 2001 is the core team that's across the way over here at the headquarters. So we've always been a really tight-knit leadership team that established the vision and our goals and our mission as to what we want to accomplish. That hasn't really changed. The only thing that's changed really is we have more access to capital because
Right.
as we generate returns, we're able to reinvest.
So taking a step back, just looking forward, actually, change does not seem to be, stagnation does not seem to be a part of your company's DNA. I've looked at multiple presentations. You guys talk a lot about constantly looking for new products to offer your customers. What are you guys doing there currently?
Well, we represent a lot of manufacturers. We don't manufacture products in our distribution business, and so our suppliers or our manufacturing partners are always investing in R&D to either enhance the current product lines, expand product lines, create new products, and so those are always constantly coming into the business. The biggest thing that we control that will affect doing business differently with our customers is really this group that we call our supply chain division, and that's where we just become an extension of the customer. So generally, a branch carries a lot of products.
Give and take there.
There is on the regular non-committal business, okay, which would be like a branch supporting 300 customers in one given territory. The thing I was trying to describe that's different for us now is we have this group that's growing rapidly where we actually have a whole team focused on one customer only in their facility. We remove duplicate SG&A. The capital employed comes off their balance sheet. Our systems are integrated. Everything's electronic with the customer, and so we become
That's literally a partnership.
That's beyond partnership. Yeah. We're in their headquarters. We're in their operations. We're on their platforms, and all the capital employed on the platform is our capital employed. So the customer's not duplicating it with our branches. So it's a model that, especially in this market, when customers are trying to improve, reduce expenses and improve capital employed on their balance sheet, are really eager to explore and expand. So we have a lot going on in that space right now.
So moving on to more of what you guys do with M&A. National Oilwell talks a lot about how effective and efficient they have been, for decades at acquiring companies, integrating them. They talk about the playbook and everything. Mm-hmm. Did you guys take the playbook with you?
Well, don't forget we did a lot of M&A, at least from 2001 when I took over through 2014 when we spun. So we had done, I don't know how many dozens and dozens of acquisitions. Right. So we used the same playbook that NOV did. The only difference really is it's our part of our DNA. That was our school. If you think about going to school to learn something, we went to NOV school to learn to do acquisitions, both targeting them, valuing them, and integrating them. The biggest difference that we've made since spinning is that, NOV's playbook includes like 5,000 sheets on an Excel spreadsheet, right? With all this stuff you got to do to make sure you integrate properly. We just automated it with software. So now all teams have access to the same data at the same time, day one. We're not duplicating requests to the company we acquired, just bombarding them with the same request over a month from 5 different functions within the company.
Now.
It's quicker, it's more efficient, it's more effective. But that software that we use is just a more efficient way to use the playbook. So if you went over there, you'd probably see the NOV logo on all of our playbook pages.
Oh my gosh, so just photocopied dozens of times.
Well, no, we just took it with us.
Cool, very good. So speaking of acquisitions, you guys have made 2 recently, Challenger Industries and Odessa Pumps and Equipment. If you could, without getting too deep, talk to us about how that's been going, how the integration's been moving on, how happy you are with the acquisitions, all that.
Yeah, so we've completed 9 through Odessa, and Challenger's yet to be closed, but it should be. We got approved by the government. We're just doing some due diligence around some other items, but So I can't tell you how well they're doing this very second because they're not part of the company yet, but they do fit a really targeted market for us, which is we've always wanted to expand our participation in the midstream market and in the downstream industrial market. We're in both, but we wanted to grow our participation. So Challenger's well known by customers for being excellent service providers in that space. Odessa Pumps is exciting. We had some facilities in the original distribution group at NOV that would design pumping systems for customers and fabricate skids and put them on with prime movers and put them out in the middle of the field to move fluid around oil or gas or whatever. Odessa Pumps brings an entire array of product line that they've assembled over their time frame.
That you guys did not have before.
Did not have. That's way more expensive than ours. So if you take what they do really, really, really well, and they're only in the Eagle Ford and the Permian and the Mid-Continent and a little bit New Mexico. You take that skill set and their product line expertise and you plug it into the rest of the distribution network, you can really grow organic share pretty rapidly.
That was, I assume, a big part of the rationalization for the acquisition.
Oh, absolutely. We have we have just general products, pop valves and fittings and safety goods that just anybody can distribute, maybe not to the same degree we do because we have more leverage, but we have other product lines that are a lot more value added that give the customer a lot broader solution at our company, and we have like an artificial lift, an electrical, and valve actuation, and we've always wanted to expand our pumping solutions, and this is a great way to get a good leap on that.
Awesome. So we're obviously in a bit of a downturn right now.
A little bit?
Just a
Small one?
A little bit. Doesn't happen a lot. Obviously, acquisitions and just adding to your product line are part of your company's DNA. How much, given the downturn, of your acquisitions in the past and going forward have been product driven, or just kind of plugging this into our distribution network would be awesome, or more opportunistic, like this is really undervalued now because the market crashed and we can get a good deal on these guys?
Yeah, so we have a saying at NOV that's definitely still said here, which is if you fall in love with a deal is the best way to bring a company down. Okay,
Got
so
it.
we have lots of companies that fit our intended capital allocation strategy, which is energy branch expansion outside of the U.S. and Canada, because there's a lot of market out there to be had. Our product line solution expansion, whether it's what I mentioned earlier, valve actuation, electrical pumping, or whatever. Growth of our participation in the midstream and downstream market. So we have a really focused area around where we want to allocate capital. But at the end of the day, it's got to be valued the right way, and it's got to be accretive, or we're not going to do it. So there's been lots of deals we've looked at since we spun in June that would have been what I would call in your category of we got to have it. We just didn't get it. I mean, just
Wow.
the bid-ask spread was too big,
Yeah.
and our discipline that we've been trained through at NOV is just not gone away. So.
Yeah. Was there an element of like flying blind with the bid-ask spread and everything? Because this is not the first time that I've heard that. Between the energy companies we've talked to this week.
Flying blind in that.
Yeah, just the bid-ask spread, so nobody knows quite, the
Well, we
salary.
know what we're willing to pay, and we know how we're going to value it. Now, what they're thinking is, I can't control. So we've had some acquisitions that we missed out on that would have been, sizable for us and really a good fit around our strategy that went for considerably more than we would ever value a distribution business. So
Right.
how those other companies made those determinations is up to them. I don't have any idea how they came to that conclusion.
Yeah. So in a lot of your investor presentations, you talk about how acquisitions are valued at current profit and losses. Obviously, probably gone skewed toward more towards losses in the last year. Obviously, if you could get it at the bottom of a downturn, obviously in the upswing it becomes even more valuable.
Yep.
How much pushback have you seen? How much apprehension have you seen in potential acquisitions being like, we don't want to sell right now?
Well, obviously, we started up our M&A effort in earnest after we spun in June of 14.
Trying to hit the ground running.
Yeah, because we'd really turned it off the
Right.
2 years prior. We had so much going on between the integration of Wilson and C. Franklin and spinning and the SAP rollout and all that stuff. When we re-engaged, in that time the market was still really hot, and
Right.
so the bid-ask spread was like the Grand Canyon. It started to shrink early this year. In fact, some of the companies we pursued last year are no longer in business today, and we could have got it for inventory value, but there's really no reason to do it because I'm just going to pick up the revenue.
Right.
So we actually passed on deals that we'd offered, our normal valuation for last year. So it's getting smaller. People are more and more interested, and I think most firms are out there trying to figure out what's the length of the legs on this downturn, right? And I think if you listen to Schlumberger, who just had their call, or Halliburton.
That's actually what I was about to bring up.
Yeah, or Halliburton, they don't agree either. Halliburton
Yeah.
says we bought him in first quarter next year. Schlumberger says it's a 2017 recovery, and then everybody else is somewhere in between. So I think as people learn and believe and come to the conclusion that this downturn's got quarters and quarters and quarters left in it, if say it does, because no one ever knows.
Right.
Some opportunities for companies we've gone after we weren't successful with will be a lot more likely to occur.
Wait 6 months, yeah. So moving on to a few questions, we actually asked our Foolish Investing community about a few questions they might have for you guys. The first one is, you've stated in the past that you had a goal of reaching 8% EBITDA margins down the road. Are you still on track to reach that number, and if not, why?
Okay, so we accomplished that prior to acquiring Wilson and C. Franklin, and so our belief was once we got integrated and got on one platform and got rid of all this duplication of overhead, that there was no reason why a larger company couldn't reach the same ratio we got
Right.
to as a smaller company. And I've always gotten pushback from shareholders going, well, does that mean you have to do acquisitions to get there? And does that mean you have to grow revenue by some $1 billion to get there? And I'm always like, no, at this revenue level, we can get there. It's going to take some work and some effort. We got to get on one platform and get rid of, all this additional expense. But it has to be at least this revenue level unless we change the nature of our business and restructure it to be a much smaller company. So definitely have to get back to our revenue level we were when we put that goal out back in June 14, which is 4.23 billion of rev. And I think we can get there. In fact, the downturn just helps us get there because it's, it would have been tooth and nail fighting over expense reductions after we went public in a hot market. And this market's kind of just taking care of it for us. So, we're down.
Welcome to Wall Street.
Exactly. We're down. We've reduced expenses already in this downturn more than we ever thought would be possible.
Right. And actually, I do have to compliment you on not only your cost-cutting initiatives, but also your balance sheet. I mean, it's a work of art.
It's actually not. We've done a great job of taking them off the balance sheet, and it's horrible.
You're not satisfied. I like
No, not even close. We said on our last call for Q2 that we thought we could take another 250 to 300 million off by the end of the year. And I think that I would be disappointed if that's all we get.
That is good to hear. Mm-hmm. You've done a great job funding acquisitions with working capital. How much further could you keep doing that before you start having to tap other funding options?
So you're right. So we finished Q2 still net cash, I think, not by much, but still net cash after completing. After completing a lot of acquisitions, and it's all come from the balance sheet. So obviously, we need to tap other funding options based on the size of the deal. So if we keep doing $100 or $200 million deals, well, likely still going to be cash positive in the coming quarters.
Yeah.
We also have a line of credit that's largely untapped. That's $750 million unsecured. And we got a $250 million revolver on top of that, which is available to us.
Yeah.
So we have plenty of ways to tap. Obviously, the size of the deal would dictate whether or not we're able to fund it from cash or from revolver. Our shareholders want us to get some leverage, which we have none. I'm trying. I'm probably the only person in the energy industry right now trying to get levered. And so we're doing our best, but we don't want to get any more than 20 to 40% debt to equity.
Yeah.
We just don't. So I still have to spend, I don't know, $1.5 billion to get anywhere near that number. So we have
to really try.
We have plenty of runway, if the right deals come up. But if the right deals don't come up, you're just going to see our balance sheet not get levered.
You don't hear that every day. I have to spend $1.5 billion
just to get barely levered.
Keep trying. So moving on to general industry outlook. Obviously, everybody in America, everybody on CNBC, newspaper, everybody's talking about what's going on with oil. Prices down 60%. Natural gas is at 2.5 or something. How is the operating environment? From your perspective, what are you hearing from your customers?
Well, most of our customers are not real clear on what they believe is going to happen in the market. So we were at an event just last night with one of our biggest onshore and offshore customers, and had four senior vice presidents there, and you get a different answer from each of them. One does onshore, one does offshore, one does drilling and completion. So no one really knows where this market's going to go. There's so many things that can change the oil and gas market that are outside of your control, beyond supply and demand. But I think we're yet to find this out because this is our first time to be in a downturn since the development of the shale plays and the technology for extracting oil and gas out of those plays. I really believe that U.S. has become the new swing producer, taking it away from OPEC. I really do. I mean, because we can shut it down quicker than they can, and we can turn it on quicker than they can. So I think what you'll find is we may, as we have always had cycles in this industry. I was born and raised in the 80s in West Texas, so I got to see the 80s, as a kid, and then had many since then.
How does that compare to today?
I thought the 80s was the worst it could ever be.
Yeah.
No.
And because it went on like
this decline is worse than anyone in my lifetime.
Really?
And I was born and raised in the oil fields. This is the worst of my career with respect to the sharpness of the decline.
Yeah.
Even
capital expenditure.
Even if you compare it back to 2009.
Yeah.
We dropped faster than 2009.
But we
way
bounced
faster.
back, yeah.
Then we recovered to the same dip in 2009, and then we went this way when 2009 went this way.
Yeah.
Okay, so this is definitely the most challenging environment I've ever been in. So, I think what's going to change in the States is I think you're going to see possibly more severe cycles that are more compressed, which honestly would be a benefit to us because most of our competitors can't manage through those kinds of cycles.
Well, not only that, but it puts a burden on E&P companies to increase efficiency. That means improve products, technology, all that.
No doubt about it, and it's gotten a lot more efficient in the last 3 years than it's ever been. I mean, one of our customers cited that their well costs have dropped from $12.5 million to $6 million.
Yeah.
And they're still dropping.
Right. No, it's getting crazy. So what, just comparing this, I'm really interested to talk about the 08-09 downturn where we, went down to 37 and bounced right back up and then, all that. Compared to today, what are you seeing in terms of capital budget cuts from your customers? What were they doing then versus what are they doing now?
So customers typically announce their budgets around this time frame, this month or next month or whatever. Most of them are saying they're not putting them out till January, February next year. So it's still
they're holding out.
It's still questionable. I think Q4 for anybody in the oil service space could be the worst quarter for sure. In that you got budgets running out because people are trying to live within their cash flow.
Yeah.
And you got the holidays. So you put all that together, it could be a pretty difficult quarter for anybody. In fact, I think Halliburton, Schlumberger, and Baker are all saying the same thing as well, that Q4 could be a really difficult period. Just the question is, does it recover in Q1 or does it recover in 2017? And I don't think anybody that thinks they have the answer to that question is fooling themselves.
Is lying, yeah. So looking at your more recent results, a lot of your customers have, your Now's margins. A lot of your customers outside the United States and Canada, it's been small, but there's still operating profit margins. Have you found that international, foreign actual countries, or have you found that customers outside North America are more willing to ride out this downturn in terms of what they're willing to spend?
No. What happens? It's such a different dynamic because most of our customers outside of Canada and the U.S. are largely driven by decisions made by national oil companies.
Right.
Many of these national oil companies have a lot of social programs, okay? So they can't, like Venezuela or Saudi Arabia or Mexico or you name it, okay? So they don't have the same drivers for decision making that, somebody in the States and Canada would, or offshore Gulf of Mexico. And so, and most of their projects are big projects. These are projects that you just don't, like if the oil price comes up to $70.
Yeah.
Somebody in Bakken's going to put 12 rigs back to work tomorrow morning.
Right.
Okay. If someone in the Gulf of Mexico or someone offshore Venezuela or offshore, it takes years to get that project started. And then when the oil price crashes, you don't just turn it off like you can just lay down a rig on a land play. So they're just lagging everyone else because they can't react as quick as a land play can.
So we've seen this, more than 60% drop in the U.S.-based rig count, just onshore. Do you anticipate a major drop in production coming up in the next 6 months once that actually gets felt?
It's not a really difficult thing to calculate. If you look right now, what's happened is production growth is dropping.
Right.
Okay. So production is dropping, but it's still over prior quarters, prior years because it's coming down, but it's still higher.
What's the word? They started to roll over, is what they said.
Yeah, exactly. So if you just extrapolate that decline rate, for sure, we're going to have some serious declines in the offshore play. Well, the one swing factor in that is that used to the total cost of drilling a well and producing oil and gas, the biggest expense used to be the drilling contractor.
Right.
Has been forever. Now
That's no longer the case.
Now it's the service company that's doing the completion work, the frac job. Okay.
Right.
So what customers have done, which is inconsistent with any other downturn I've ever been in, is they're still drilling some wells. The rig count's down 60%, don't get me wrong, but it'd be down even worse if it weren't for this new phenomenon. They're drilling and not completing, drilling and not completing,
There's
drilling and not completing. So if
there.
oil comes up to $60, $65, $70, all they got to do is get the frac spreads back out. Okay, and they can have production on that fast. So you could see a spike in production, a drop in prices, a drop in production, and a drop in prices. I mean, who knows what we're going to go through? We have a completely new world out there that we've never experienced before.
So let's just pretend that happens. Oil pops up 70, 75. You guys, you're not an oil production company. You supply more than 30,000 products to the guys that do that. How long before you start seeing the benefits of them getting those rigs back on and everything?
So the worst thing about this business is that when the market declines, we're the first to feel it.
Right
off the bat. I mean, the minute the rig goes down, it stops buying. The minute that the operator stops drilling, they stop doing tank battery hookups. I mean, we feel it immediately. Where other companies have backlogs, like NOV.
Right. That
was one of the best things you asked me earlier. What's good and bad about not being part of NOV?
The
good part about NOV is they had a 10 or 15 or $20 billion backlog. So when the market went down, we didn't have to react that fast, and we could make more conscious decisions about sustaining our future that didn't try to make people happy about our performance in a given quarter.
Right.
We don't have that here. Okay, we have no backlog. So the worst thing about this business, it drops first. The best thing about this business, it reacts first. So there was a little blip about 3 months ago where oil got to $60, and about a dozen or so rigs went back to work in the Permian. Those rigs needed $30,000 to $40,000 worth of parts within 24 hours to get those rigs going back to work. which is about 6 weeks of consumption ish
Right.
on operating rig, and it didn't reduce their consumption. So they consumed like normal, but they needed all that upfront stuff. So the worst thing about this is I'm gonna have every CEO of every land contractor calling me at my house complaining at night when they try to put 500 rigs back to work,
Right.
and I don't have enough stuff to supply those rigs to get them back to work.
Wow. So you had a lot of the employees were burning the midnight oil.
Well, 12 rigs we can handle.
Yeah.
Okay, but if you have a real recovery,
hundred, yeah.
we're gonna
So moving back out to investors, what are 3 things that a potential investor, maybe a current investor in now, you think they should know about how to properly evaluate your business?
So I would say there's 4 things you should hold our feet to the fire about. Okay, one is, are we growing share organically? So
Okay.
so that's why on our call I call out what's revenue per rig without acquisitions and what is it with acquisitions, because the minute that we get into having to buy revenue growth, you got some problem. Okay,
Yeah.
doesn't mean every single quarter we're going to grow organically, but we need to have a trend that says we're growing organically. 2 is, are we, regardless of what's going on in the market, are we managing our P&L in a way that we're improving all of our ratios, whether it's
Right.
EBITDA margins or net income or whatever. 3, working capital. This business's biggest risk in the world is working capital. Okay, that's it. So I don't have much capital employed in this business other than receivables and inventory. And so how we manage our working capital as a percent of our revenue is really important. And 4th, a big part of our story is the fact that we have a super clean balance sheet and we're going to allocate capital for M&A. And are we allocating it consistent with our strategy that we've communicated to the whole investing public? And are we doing it wisely and with discipline? That's the 4 things I would watch on us.
So before we wrap up here, again, thank you so much for your time. Just a little bit more of a lighter question. At The Fool, we're big fans of Peter Lynch, obviously a very famous investor. And one of the things he loved to do when he sat down with a CEO was ask him what other CEOs, inside or outside their industry, that they admire, that they like to learn from. Who do you admire, inside or outside your industry, that you admire?
There's several firms that impress me with respect to how their team leads their organization that are distributors, actually, not necessarily competitor to me, so maybe that much of a competitor, right?
Right.
Out there. But the one that I learned the most from was the NOV team under Pete. I mean,
Right.
think about it. There was 5 of us that were on that team or so. I think it was 5. And most have gone on and are currently CEOs of large public companies.
Right.
Okay, so, something went right there. And just how our team worked together in different businesses doing different things with sometimes similar customers was my learning ground. Outside of that, I really lean back and spend a lot of time on some of the teachings of people like Peter Lencioni and Jim Collins. I mean, I have leadership team meetings every quarter with my staff. We spend a half day, full day just going into those types of areas of leadership development and as a team working through these exercises and having debates about how we apply it to our business and principles. So really it's either these executive coaches or these executive experts, or it's what I've learned for 15 years at NOV as being part of the leadership team there, facing all sorts of challenges in capital allocation and market swings and everything else.
Well, there it is, folks. Wanted to say thank you very much for listening this week. I know it's a little bit different, and I hope you gained something out of that interview. I know it was one of the things when I was actually in the behind the scenes. It was certainly a lot of fun and a whole lot of interesting tidbits that certainly made me as an investor in a company like Distribution Now much more confident knowing the people behind them and what they're thinking rather than just looking at it as a piece of paper. So if you're a loyal listener and have questions or comments for us, just email us at industryfocus@fool.com. Again, that's industryfocus@fool.com. And also, we have just completed what we'll call the best of 2015. It's a recommended reading list of all the best articles that appeared on The Motley Fool all over the entire year of 2015. We had more than 20,000 articles, and we picked probably the best 30, 40, 50 of them for you. And if you want to check those out, just email us and we'll send you a copy of all of those for your reading pleasure. And as always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy our stocks based solely on what you hear on this program. Thank you very much, and we'll talk to you next time.